Boomtowns were once a feature of the American West. They sprung up anywhere that gold, silver, or other valuable resources were found. And we've seen a trend in boomtowns, well, at least when it comes to real estate, during and shortly after the COVID-19 pandemic. But now those trends are beginning to reverse. And we're going to look at a recent column from Business Insider that tells us as reverse mortgage professionals what we need to be aware about in one specific region of the U.S. and other areas that have not been impacted. RIP Zoomtowns. Yes, the new Boomtown is a Zoomtown with the work from home craze, which took off during the COVID-19 pandemic. It was just a few years ago that housing markets in the warm, sunny parts of the U.S. looked, well, warm and sunny or inviting. In the halcyon days of 2021 and 2022, cities such as Austin, Tampa, and Phoenix and Atlanta attracted swarms of movers, and home listings drew multiple offers above the asking price. And buyers plunked down all cash offers to fast-track their purchases. In fact, many individuals purchased a home sight unseen just with the online photos, no home inspections. Can you believe that? But now that has changed, and the big winners of the work-from-home reshuffle, those metros that drew hordes of footloose workers and disaffected coastal dwellers, have turned into losers. Fewer are moving into these so-called Zoomtowns, and listings are piling up on the market. Prices are now dropping, and there's a lot of angst among those home sellers trying to get their property offloaded, and they're just having a very difficult time. A new report by the real estate analytics firm Podca Labs, shared exclusively with Business Insider, shows that home sellers in the lower half of the U.S., also known as the Sun Belt, are the most desperate in the country. However, there are metros in the U.S. that have remained relatively untouched from this boom and bust cycles, areas such as the Midwest and the Northeast. There are cities that didn't garner much news coverage during the pandemic and the run-up in home values, cities such as Buffalo, Cleveland, Milwaukee, and Detroit. Home sellers have quietly held on to their advantage. We are in a two-tiered housing market, said Mark Simonson, chief economist at the brokerage firm Compass and the co-founder of Altos Research. It's really stark. One factor that's pushing home prices down in the American South and also in the Sun Belt is the sudden surge of inventory thanks to home builders who began a glut of new construction in these areas. Now many areas in the American South, such as the Sun Belt, are seeing a massive run-up and even a pile-up of housing inventory thanks to rapid home building. Despite pandemic relocations, apparently, as they say in The Wizard of Oz, there is no place like home. Between mid-2018 and mid-2019, the last full year of the census data before the pandemic, the Northeast lost a net of 294,000 residents to other parts of the U.S., while the Midwest lost nearly 162,000. The South, on the other hand, gained almost 408,000 people, and the West saw an uptick of 48,000. So what are the takeaways for you as a reverse mortgage professional? One is that the older homeowners in the Sun Belt and the southern U.S. may have less tappable equity as home values have stalled out and in many areas have dropped even as much as 10% year over year. However, if you're looking for home values that have not eroded and that have been relatively stable, then you want to look to the Midwest and the Northeast. I know the Midwest doesn't have the higher home values, but the Northeast certainly does. So that's one part of the country you may want to be increasing your focus on when it comes to stable home values and you have less issues with short to close or challenges with the principal limit factor based on the home's value. But there is a silver lining in this situation. Seniors and volatile housing markets may be more open or receptive to the idea of a reverse mortgage as they become aware that their home equity is not always a sure bet that it will be there tomorrow. In fact, they may see that home equity drop precipitously in the years to come in these overbuilt markets. So that is what we've learned from Business Insider this week. Again, these migration patterns have reversed after the return to work orders for many companies, and now we're seeing the consequences of that order. Perhaps you've noticed, or most certainly you did, that the key index for the home equity conversion mortgage's initial interest rate, that is a 10-year constant maturity treasury rate, has been dropping quite significantly recently. And so we're going to look into the factors that are influencing the changes in 10-year treasuries and what that may mean for you as a reverse mortgage professional. One factor is a more dovish Federal Reserve. The slide in Treasury yields in face of record high stock prices, tight credit spreads, and sticky inflation suggests that investors have accepted that the Federal Reserve's chair, Jerome Powell, is being driven more by employment instead of inflation, and that could mean more future rate cuts. And Bloomberg reports that traders are bracing for lower Treasury yields and hedging costs are rising. As a result, bond traders are preparing for Treasury yields to drop even further. Other factors that are pushing down the 10-year Treasury are signs of a weakening job market, and that is one major concern for our economy. Another factor influencing 10-year Treasury rates is a weakening job market and slower job growth. Many are anticipating more Fed fund rate cuts as the central bank has signaled their willingness to be more accommodating to recent economic data. With the protracted U.S. government shutdown, which may be longer than the last one we had in 2018 and 19, and increasing tensions with trade with China, investors are now flocking towards safe money, such as treasuries, and that's driving yields down. Between September 2nd and October 20th, the 10-year constant maturity treasury rate shed 28 basis points, dropping from 4.28 to 4%. And since January, the index has fallen 80 basis points, or nearly 1%. But what about those with an existing adjustable rate HECM? How are they impacted? Because their monthly rate is keyed to the secured overnight financing rate, it fell from 5.34% in September 2024 to 4.18% by the middle of this month in October. And while that will slow the accumulated interest and negative amortization, it will also slow the growth of the line of credit. So that's the impact for them. In the past, when we've seen interest rates or the 10-year CMT fall significantly, that has spurred a boom in HECM to HECM refinances. I expect we will see a significant uptick in those refis, but there is another opportunity we don't want to overlook. And that is to reach out to those previous contacts of ours, or previous prospects who maybe were right on the cusp of not qualifying or were short to close, and then seeing if they qualify today. I think that's a great place to begin. And I think it would also give us some real tailwinds in origination later this year. So let's keep our eyes and ears open. But I do not believe that this is going to be a long-term situation with the 10-year CMT. That's just my opinion. And here's what some analysts have to say. Historically, a drop in the 10-year CMT, or constant maturity treasury rate, has triggered an uptick in HECM to HECM refinances. And we saw that, of course, play out during the pandemic, as nearly one half of all HECM endorsements came from HECM to HECM refinances. But there's a larger opportunity that we don't want to overlook. And that is those homeowners that we contacted previously that were right on the cusp of qualifying or were perhaps short to close. Now is the time to reach out to them, because I do not believe that these rates will last very long, if maybe for 2 to 3 months, where they begin to normalize, as most forecasters expect, in the range of 4.5% to 5%. The Florida legislature is currently debating some very ambitious proposals that may determine how homeowners in the Sunshine State pay property taxes, if at all. CBS Miami reports that Florida lawmakers are considering a range of sweeping proposals to overhaul property taxes for homeowners. Options under discussion include eliminating property taxes for homesteaded properties, phasing them out over 10 years, introducing large exemptions such as removing $100,000 from a home's assessed value, taxing only 25% of the property's assessed value, or creating a special tax break for older homeowners. And I think the last one is more likely if this does pass, but it's going to be an uphill challenge. If passed, this would be a big win for Florida homeowners, but it would impact local governments. CBS News reports that property tax revenue forms a large portion of municipal budgets, $193 million a year in Hollywood, Florida, $310 million in Miami Beach, and $251 million in Fort Lauderdale. That's what goes to pay for city services like fire, police, public works, parks department, even pensions, said Arlene Borenstein, spokesperson for the city of Hollywood, Florida. If this proposal does move forward, it would likely go to the Florida voter to be approved as a constitutional amendment. Yes, an amendment to the state's constitution. Now, for homeowners, it's hopeful news. If this does pass, it could reduce one of the biggest recurring expenses for home ownership in the state of Florida, especially for the older homeowner who's living on a fixed income. But there are some potential impacts that you as a reverse mortgage professional will want to be mindful of. And first is if property tax liabilities do drop significantly, then there may be less pressure for the homeowner to tap into their equity to cover property taxes. Now, of course, we know there are more financial concerns or pressing issues beyond property taxes, such as homeowners insurance in that state, but that is one consideration. Next is that lower property taxes can make holding the home more attractive for the older homeowner who is considering whether they should relocate or just stay put. And staying put may make the older homeowner more inclined to consider a reverse mortgage. If you are speaking with Florida homeowners, be sure to let them know nothing is, of course, settled yet. This may not even pass or become part of the state constitution, but you can let them know that it is being proposed and they are working on this. I think the state's going to have to take some sort of action. Property taxes have become extremely onerous in many states in the American Southeast and Southwest.